Hey, good morning. Welcome to RIA Advisors Candid Coffee Mid-Year Review. We appreciate everybody joining us today. We know you guys have lots of things you could be doing. If you are in Houston, you could be outside before the heat starts or something of that sort. I'm sure it's already here. But we're going to jump right in. We are Clarity Financial, doing business as RIA Advisors, a registered investment advisor with the Securities and Exchange Commission. So please keep everything in mind that this is not a specific recommendation, but it's supposed to be educational, answer a lot of questions for you guys. You know, we started Candid Coffee during COVID, really just to make sure that we were addressing any concerns, needs, obviously a lot going on. And so want to stay on top of that. So we have a ton of questions and a lot to get into today. If you do have a question, please go to the Q&A. We're going to try to answer those as best as we can. I think we're going to address quite a bit of this as we roll through this, but Lance, Richard, thank you guys so much. Let's talk about the big picture. You know, where we've been so far throughout the year, first 6-7 months of the year, and how we got here and where we're going.
Well, so how we got here. Well, you know, this has been kind of an issue of two things. One, of course, you know, we had the economic shutdown back in March of 2020. We then followed that up with $5 trillion worth of stimulus spending, combined with $120 billion a month in quantitative easing that led to a massive market boom. Of course, beginning in January of 2022, the market set up for a reversal. We got extremely extended above long-term moving averages and means, et cetera. So the eventual reversion was not surprising. Again, last year, to be clear, was not a bear market. It was a correction within an ongoing bull market. And the reason that differential is so important is that if you look back at real bear markets that, you know, occurred in history, whether it was the dot-com crash, the financial crisis, the 1974 black bear market, 1929, it took years, you know, between 5, 8, 10 years for markets to get back to all-time highs. In corrections, like we saw in March of 2020, it was a 35% drawdown. Everybody said it's a bear market. It wasn't, because we got back to all-time highs even before the end of the year. So when markets quickly retrace back to all-time highs, those are corrections, not bear markets. And so far, the market has retraced this year, 78.6% of last year's decline. We're likely to be at new all-time highs by the end of this year. And that seems a little bit odd to think about it, because we have all of these different, you know, economic indicators that suggest that, you know, there's a recession coming, right? We talk about the inverted yield curves. We talk about leading economic indexes. We talk about all these different things. And yet there's been no recession so far. And, you know, so this has been one of those challenges that, and by the way, these charts I'm going to go through right now, these are in this weekend's news. This is the topic of this weekend's newsletter. I literally just posted it right before we got on this webinar. So if you go to realinvestmentadvice.com, click on the new, you know, go to the Insights tab, click on the newsletter. This is this weekend's newsletter, but we go through this in a little bit more detail and kind of show you where we are right now. But here's the important part, is that the market is rallying this year on expectations of economic and earnings improvement. The market tends to lead economic earnings growth by about 6 to 9 months. And mostly because the reason for that is that markets act real time and we don't get earnings until the end of the quarter, right? Like, so just this week, we started the analysis of second quarter earnings. So we're now just getting the first look of stuff that happened back in March. And so that's the reason that markets tend to lead the economic and financial data, because of just the lag effect of collecting that data and actually getting to see it. So markets anticipate these things happening. So, you know, as you can see, you know, last year we had the drawdown in the markets troughed in October. The markets are now rallying, and they're rallying in expectation of an improvement in earnings. And so we can see this if we just simply overlay the this same annual rate of change of the market relative to earnings growth on an annual basis. You know, so our earnings on an annualized basis increasing or falling. Right now, we've had a very big drawdown in earnings from last year. Not surprising because of what was happening economically. But as you can see, the market has turned up, and we're now starting to look at the second quarter earnings. So between second and third quarter, we are likely going to see earnings start to improve. Now, this is an important point because earnings can't improve unless you have economic improvement. And this is the one thing that people are, having a hard time with now, because now we go back to those economic indicators saying, oh my gosh, leading economic indicators, yield curves, these all tell us that a recession is right around the corner. So, I don't want to be invested here because, this recession is going to come and it's going to create this big crash in the markets. But again, the markets and the economy all cycle. This is so this chart right here is two important charts overlaid on top of each other. One is the leading economic indicators. The best one of the very best recessionary indicators historically has been the leading economic index. Whenever it's had a very big drawdown, you've always had recessions. The black line is our internal economic composite index. It comprises over 100 data points of both hard data, such as manufacturing data, and soft data, services data. And of course, as we talk about what's going on service-wise in the economy, the ISM Services Index is in expansion territory. It's not in recession or contraction territory. The manufacturing index is, but importantly, the manufacturing composites, the hard data in our economy, only make up 20% of our economy today. So when we take a look at ISM and look at the Philly Fed regional manufacturing indexes and the New York Empire State Manufacturing Index, they're important indexes. Don't get me wrong. They do tell you what's happening on the manufacturing side of our business, but we've exported the vast majority of our manufacturing overseas. So now manufacturing only makes up about 20% of our economy. Services such as Uber, Lyft, Airbnb, Grubhub, those are our service businesses that make up now about 80% of our economy. And so when you have a very large chunk of the economy based on services, we want to make sure and incorporate that into the analysis. And what we're seeing here, of course, is that we've had this big drawdown in the economic data. We've had this big slowing in the economic data. And normally when you're at these levels, with the exception of 2008, the financial crisis, and of course, the 2020 drawdown where we shut down the economy literally. And then we have to go all the way back to basically about 1980, when we had the recession then, to see levels lower than where we are currently. And so the point here is whether or not we officially have a recession or not is not the point. The point is that the economic cycle is now at a level where it normally troughs. So again, kind of going back to our previous chart on expectations of the market is rallying, now expecting that earnings are going to start improving, now expecting that economic data is going to start to improve over the next 3 to 6 months. And again, this is kind of hard to kind of, to kind of rationalize, considering that we've still got the Fed hiking rates at the next meeting, considering that we have, tighter banking standards across the country. We're seeing the number of people getting rejected for credit on the rise. We're seeing the number of people getting rejected for auto loans on the rise. So there's still a lot of these headwinds that are weighing on the economy that certainly make it difficult to expect a turn in the economic data. But therein lies the trick, which is that we analyze data on a year-over-year basis. So if the data, while still bad, is less bad than it was last year, we're going to start to see an improvement in these indexes. Now, I remind you that none of this means whether or not we will have an official recession. I'm not talking about that at all. All we're talking about is economic data versus where earnings come from, and earnings are dependent upon stronger economic growth, which leads to market expectations. So it's just simply the relationship between this. This has nothing to do whether or not the National Bureau of Economic Research declares a recession or not. That's irrelevant at this point. But continuing on here, just taking a look at, we see the same thing. If I take that same economic composite index, overlay it to earnings, we see a very close relationship. Again, as I said before, earnings have to come from economic growth. Earnings just can't magically appear. They have to occur from economic activity. That's you and me going to Lowe's or Home Depot or whatever, buying stuff. That's where economic data comes from. So if the economic data is going to start to improve, we should, in theory, and of course, as historic data says, we should see an improvement in that earnings data. And the one thing that, we've all kind of, we're kind of looking at the Fed, we're saying, okay, the leading economic indicators say we're going to have a recession. The The Fed's tightening interest rates, and we're going, well, why have we gotten a recession yet, right? Why has this recession not shown up yet? Well, one reason is because, as this chart shows, the orange shaded area is GDP. That's the economy, clearly slowing down. This is nominal GDP, not inflation adjusted. So this is just nominal GDP, clearly slowing down. We have definitely had a slowing of economic growth, but it's not anywhere near recessionary territory yet, right? We are nowhere near negative growth. And that was because of the massive surge in economic growth that we had because of $5 trillion in stimulus. It's, it's the old pig and a python type relationship, which says, we put this massive pig inside of this python. It's going to take a while for all that monetary excess to work its way through. And we did see that monetary excess drop off very sharply in early 2022, which was why we had the downturn in the economic data in the first 2 quarters last year. We had negative economic growth. In the first 2 quarters, we had the market slow down, we had earnings fall. But one of the reasons we haven't seen a recession yet is because since the middle of last year, we've had a massive uptick in that federal expenditure. That's that Inflation Reduction Act from the Biden administration. That's other spending programs that have been in there. And then let us not forget that student loan payments have been on moratorium. Last year, you had no payments for rent. You had no payments for mortgages. So that's still in the system. There's still, $12 billion a month, roughly estimate, sitting out there in the economy right now that isn't having to be paid back on student loans. So this could be a problem later this year. And it's something I think we need to watch very carefully, which is the student loan repayments, unless the Biden administration can figure some supreme and forestall those payments being made. There is a catalyst for that economic recession later this year if those student loan payments restart. And of course, this will kind of change the dynamic of the markets and the market game if that occurs. We're not there yet. But importantly, pay attention here. There's 2 very important parts to this chart. One is that red line. That red line is tax receipts. You have never had such a big decline. So here we go back to the no recession argument, right? You've never had such a big decline in tax receipts and not had a recession. But yet that's being offset by this massive surge in governmental spending that's supporting economic growth. So this is the big challenge. So what does this all tell us? This is the big challenge for investors right now, is whether or not the economy can support estimates. And what this chart shows you is the earnings estimates into 2024. Currently, analysts expect the S&P to hit $224 in earnings per share at the end of next year. That is by far the highest level on record, and extremely deviated from the long-term growth trend. And as you can see, from a peak-to-peak basis, earnings tend to grow at about 6% on average. That's that green sloped exponential line on the top. They're expecting earnings to grow well beyond 6% growth over the next 2 years, basically a year and a half, which has to be tied ultimately to economic growth. Economic growth cannot grow at 6% anymore. It's going to grow at 2%. So these earnings estimates are still well ahead of what expectations are. Earnings are going to have to come down. These estimates will have to come down as real economic activity begins to slow further than what people say. And again, I'm still talking about economic growth, but it's just not going to grow at 6%. It's going to grow at 2% at best because of the debt, because of interest rates, because of tighter monetary policy. But so all this is very confusing. Hey, I know, right? This is what's going on in the markets right now. When you take a look at the market, we are now pushing rather large extremes from the 50-day moving average. It's been extremely a bullish run. If we take a look at our technical indicator chart, our technical indicators, this is a composite weekly index of multiple technical indicators measured on using weekly closing data. That's at levels that normally coincide with short-term market peaks. Investor sentiment is now getting back to very high levels. We're not to extreme levels yet. We're definitely into extreme greed levels. So market participants have piled into this market, chasing a handful of stocks earlier this year. The market is now starting to broaden out a bit because they're going, well, I missed the Apple and the Nvidia, so I'm going to go buy some small cap, mid cap stuff. And we're seeing the markets rally. But the economics and fundamentals really don't support where markets are being pushed right now on a technical basis. So again, I realize all this is very confusing. You're sitting there right now going, Lance, what the hell are you saying? You're saying the markets are going up. Are we going to have a correction? Here's the best answer I got for you. I don't know. The best answer I have is I know what the data is, and I know what economic cycles look like, and I know what market cycles look like. Right now, we're in a bullish cycle. Could that change in the near future? Absolutely. But momentum can carry this market a bit further than we think it can. And that's going to be the challenge that we're going to be dealing with over the next 6 months.
Hey, Lance, not to interrupt you, Danny, but the one thing I want to help everyone understand is, one, I personally underestimated the effect of the Inflation Reduction Act and that stimulus cash that was coming into the system from that perspective. And that continues. So I think you brought that up, Lance, which is really important for everybody to understand, because everybody's wanted this recession to happen sooner. And you keep getting this influx of cash that changes that dynamic. The other thing, and we'll probably touch upon this later, in that fear greed cycle, markets in the short term are always detached from fundamentals. We still have to participate, but it's very good, important for investors from a risk management perspective to understand that markets are going to do things that you are definitely going to shake your head about. And right now, I'm scratching a big hole in my head. I got no hair back here because it's that. So I think you laid that out really, really well for everybody. So just wanted to share that Inflation Reduction Act sort of was a stealth thing that I didn't. Oh yeah, wait, all that infrastructure spending that's finally, I read an article, it's finally moving into the system. Actually, all the projects that are shovel ready are now shovel ready, and they're moving forward on some big projects. Now, how about the weather, Lance? Also, the erratic weather and the rebuilding that comes from that, can that also stall things as far as recession and money expenditures being, hurricanes and all the stuff we're seeing and the disasters we're seeing? That's all also spending.
Well, yeah. I mean, look, anything that requires more spending is going to create economic activity. I mean, that's just a simple function of the economic cycle. And again, as we take a look at the economy, we say, okay, where does spending come from, and what generates that? And 70% of our economy is based on consumption. The other 30%, what is that? That's net exports. That's stuff we're exporting to other countries, less what we're importing from other countries. It's also government spending. It is also business investment on a real basis. Those also feed into the economy as well. So consumer spending, let's just say that consumer spending slows down some, but you have a big pickup in government spending. That's going to offset, some of that slowdown in consumer spending. Now, again, you have to weigh this in percentages, right? So if I have $1 worth of activity in the economy, 70 cents is driven by the consumers, and only 15 cents is basically driven by kind of government and business spending. So if I have a reduction of spending by consumers, it takes a huge increase in in business and government spending to make up for that contraction in consumer spending, just because of the percentage differences of weightings within the economy. So the consumer will drive this ultimately. And consumers so far have been very resilient in the face of higher rates. They've been able to access debt. They've been able to increase their credit limits. That may be coming to an end here. And again, that student loan spending cycle is something I think is much more important to pay attention to. And here's something that we've said, repeatedly in the past, is that everybody was very afraid of, the market was just kind of this watershed event, and we were going to have another financial crisis type scenario where the markets are you're just going to wake up one morning and be down 30% in the market. And that never happened, because you never had that unexpected exogenous event that markets weren't anticipating and really weren't counting on. And we haven't had that. I mean, the stuff with the banks, the stuff with, we had the Silicon Valley Bank issue, earlier this year. The markets kind of blinked at it for a moment, and then the Fed stepped in and said, okay, here's a bailout facility for you. And then participants said, okay, problem solved. We've had, the Fed hiking rates, and then of course, immediately the market sells off, and then the markets start going, yeah, but they hiked rates, so now they're going to start cutting rates. So that means more liquidity and more QE. So let's rally stocks. And we've had this rolling recession in the economy over the last 18 months. We've had just kind of one of these one-off events. Russia invades Ukraine. Then the Fed starts to hike rates. Then the Fed starts to taper their balance sheet. But these were all spread out over time. And so the market had time to get that impact, understand it, price it into the markets, and then say, okay, I got that, and then start rallying the markets again based on expectations that problem was solved, or at least is a non-event. I know what that is, it's priced in. And so now I'm looking forward. And remember, markets are always looking forward. And what's been helpful for the markets is these events that we've had have been spaced out enough to allow the markets to absorb the impact and then move forward. Kind of think about it like bumper cars. You hit somebody, you kind of back up a little bit, and then you move to the next guy. And that's what's been happening with the markets. We've had bumper car markets over the last year. The one thing that the markets really haven't given a lot of credence to, and the markets are still kind of expecting that the Biden administration will figure out a way around the Supreme Court, but the markets really aren't anticipating, in my opinion, and I could be entirely wrong. Maybe the market has priced this in. Maybe this is already accepted in the markets for what it is, but I haven't really seen an adjustment, particularly on the retail side of the market in terms of retail stocks, consumer discretionary, et cetera, to account for a $12 to $15 billion decline in retail spending if those student loan payments restart. You have 44 million Americans. You can do the math yourself. 44 million Americans at roughly about a $300 average payment. That's 12 to 15 billion a month in potential spending that is not going to be spent into the economy if those payments restart. Now, it's not going to happen overnight. It's not going to be a one night, all of a sudden, everything gets topped off at the knees. But very quickly, that inability to have that extra money to spend is going to get extracted out of the economy. And I don't think the markets really price that in to the degree probably that it should, given the rally we've seen in discretionary stocks, over the last several months.
Yeah, that's a really good point, Lance. So, the other aspect, like thinking about consumer discretionary, who would have thought that would have been one of the better sectors so far for the year? Looking at the economic data, looking at the credit, what's going on. So let's talk a little bit about market breadth. I mean, we talked about the economy, how the market and the economy are maybe not always in sync. The markets declined in an environment where they're usually doing fairly well, right? And the Fed's hiking into a fairly strong economy. Markets are doing well. It's when they pause that we see markets decline. And we've seen the complete opposite, where last year was a very negative year. What do we expect? Is it going to have the same impact when they actually stop? Because everybody's thinking about, well, they stop, they're going to start decreasing rates, things are going to be great again, right?
So let's take that back for just a second, because that is kind of an important point and something that and I've been thinking a lot about this lately. We may have taken last year's sell-off as a miscue on the impact of policy. Okay. And what I mean by that is look, the markets got extremely deviated last year from longer term extremes simply because of all that monetary liquidity. We got so far above long-term bullish trend lines that a correction back to those trend lines was just, it had to occur. We talk about taking a rubber band and stretching it as far as we can. And, this is something that occurs. So what this chart is our risk management chart that we look at. And you can see that since 2009, those two black dotted trend lines have been really the market's been running in that channel. When you get to the top of that channel, the market sold off. When you get to the bottom, you get a market rally. Well, you can see in 2020, we got extremely deviated even above that trend channel. So that correction just really, all it did was everybody's like, oh my gosh, it's a bear market. The world's coming to an end. And all it did was just get us back into our trend channel where we should be. And take a look at those bottom two charts. Those are weekly MACD indicators, both short-term and long-term. And what you'll notice is that previously, where that kind of horizontal red line was, that was when markets were very overbought on a MACD basis. And when you got that kind of overbought, that was kind of the top of the cycle. Then we get a sell-off to the bottom of that MACD cycle. Well, you can see in 2020 and 2021 how deviated we got above the long-term MACD oscillations, right? So, you just had this massive spike in these oscillators that didn't exist before. So that correction was certainly not surprising. Of course, those have bottomed. And now we're getting back to where the normal range of the market tends to be. And again, we've got a little bit more to go on the upside here to get back to the top of that kind of bullish trend cycle. And I would expect that to probably occur over the next few months. But so going back to your question, right now, there's no indication the Fed's going to start cutting rates, and there's no indication. The economic data is fine. The market's doing fine. There's no real stress on the economy at this point. So this is going to allow the markets to continue to rally probably well into 2024. But come 2025 is where we're likely going to start to see the impact of this tighter monetary policy, this lag effect catching up. We'll start to see that economic environment. So this idea that the recession occurred in advance, and normally, to your point, Danny, normally when the Fed is hiking rates, the market is rallying because of momentum in the economy. And we had this decline last year as the Fed was hiking rates, and we assumed that the market kind of front loaded the recession. But I'm starting to now think that that wasn't the case. That was simply just a correction in the markets because of this extremely overbought condition. And the recession, market sell-off recession has now been pushed out because of all this monetary liquidity and stimulus and M2 really that's still floating around the economy. That's been pushed out. So why will the Fed cut rates? The Fed will cut rates when they begin to see severe economic deterioration. If they begin to worry about an economic decline that is going to impact the credit at banks to some degree and to a larger degree than just a small downturn in the economy, they're going to start cutting rates. When they start cutting rates, that will be the recognition that a recession is incoming or has actually arrived in the economy. They'll be associated with a surge in unemployment rates. The markets will then recognize that, have to adjust for lower earnings, and then you get that next decline that will be kind of back to the historical norms of the Fed cutting rates, the markets declining as this impact and realization of economic weakness, slower earnings growth, and really a market that is priced for fantasy rather than reality occurs. But again, that's probably not going to be until late 2024, maybe even well into 2025, probably before we get to that cycle. Could it happen sooner? Sure. And the student loan payments could be the trigger for that. We'll see.
Hey, Lance.
Yep.
You need to revise this chart, and at that that deviation above, circle, and that below, still within the channel in the trench, circle, because our job is to make sure clients don't do stupid things within these channels, because it's risk management. But one of the things you always talk about, and we always talk about, is we never fully get out of the market, because the recency bias of thinking the current downturn is going to continue and you absolutely know what's going to happen is a problem. So that's a great chart. Also show what are your emotions doing within those periods, right? You got to also look at that.
Well, that's easy. When you're at the top, it's when it's at the top, everybody wants to be all in. And when it's at the bottom, everybody wants to be all out. That's, look, and I can tell you this just from, clients and prospects that I've been talking with this year. Earlier this year, January, February, March, they were like, I don't want any risk. I don't want to be in the markets. I want to be all in bonds. I just want to buy treasuries and get my 4% yield. If I can just get 4% yield, I'm great. I'm happy if I could just lock in 4%. I don't need any market exposure. And now the market's up, 16%. And those same people are going, okay, I need to sell my bonds. I need to buy equities. Why I'm not getting better performance relative to the market. And that's that fear, greed cycle, that just happens, within the economy. And look, and we were talking about this earlier. This is a chart that I run. And if you don't read our newsletter, shame on you, because all this data is in the newsletter every week. So I give you all this data to work with. But this is year-to-date performance of major markets and sectors. And you can see that 3 sectors have been driving the market this year: discretionary, technology, and communications. Those are all consumer spending. That is not economic spending, right? That's all consumer-driven spending. And that's the real risk that you've got. But these sectors, mind you, were the most hated sectors last year. Now, let's go back to 2021 when we were talking about everybody hates energy. It's time to buy energy, right? Nobody wanted to own energy in 2021. In 2022, it was exactly the opposite of this chart.
I want to interrupt you for 1 minute, because the funny thing you said then, and I'll never forget it, is when we took the profits in tech and you said, I wish we could put 40% of the client's money into energy.
Yeah.
And see, that's how investors don't think. Why are we selling some of the technology? Why are we doing this? So before you go into that, I want to help people understand is that's how we look at things. Your fiduciary money manager up in that top quadrant there with those sectors is not going to put all your money in 7 stocks or 3 sectors. They're going to try to find the best companies or the ETF flows within those other sectors and invest in those.
Right.
Right. So, it's a risk management perspective, but also looking at value, and people just have a very hard time with value.
Well, and look, and this is the big conundrum that everybody has this year. And this is and why are we having this big chase in the markets right now where, you've got this market rallying against what you would, logic says, tighter monetary policy, higher rates, the Fed's still hiking rates, all this stuff is going on. Why on earth are the markets rallying towards all-time highs? It's a performance chase right now. Everybody's trying to play catch up with the markets. Why? Because of just what I said earlier this year. Nobody wanted to be in the markets. Now everybody wants to be in the markets. Everybody's saying, well, why am I not up a whole lot more this year? Take a look at this second chart. So there's 6 panels on this page. And once you look at the one that is in the middle left, 3 sectors have outperformed the S&P this year. Now, what that means is that if you have a portfolio that contains anything other than those 7 stocks, right? Apple, Meta, Google, Microsoft, we own most of the 7, right? But we don't have all of our clients' money in 5 stocks. We own other stuff. So the point is every other sector, every other market has underperformed the S&P this year. So if you own anything other in your portfolio other than tech, discretionary, and communications, you're underperforming the benchmark index this year simply because of the bifurcation in the markets. And you can see it in the top right corner as well. That's year-to-date performance of sectors all recalibrated to $50. And you can see that every other sector is underperforming the S&P. And that's just the bifurcation of the markets this year. That's going to straighten itself out eventually. And and maybe what we're starting to see now, we've been talking about sector rotation. And over the last over the last week, really, our portfolios have been outperforming the S&P because we're getting that sector rotation now into other areas of the market where we've got exposure, right? We've got small cap regional banks. We've got some, some energy stocks. We've got some REITs. We've got some consumer staples and healthcare stocks. Those are all getting money flows here over the last couple of weeks, which is starting to help the performance of the portfolio. But that's been a long time coming. We've been expecting this rotation for the last 4 months, and it's now starting to actually occur in real time. We'll see how long that is sustainable, and we'll see if that's enough to try to get the markets to play catch up a bit here. But that's been the challenge this year is this risk management between saying, okay, if you want market performance, you've got to own 7 stocks. That works great until it doesn't.
Yeah, I think that's the big conundrum everyone is facing, unfortunately. So talking about market breadth, sector rotation, want to get to interest rates, and we do have quite a bit of other questions, but limited time. So Let's jump into the Fed and interest rates, Lance. I think that's going to be obviously a hot topic. It's in the Q&A quite a bit. What do we think about long duration bonds? I know we've been extending duration a little bit within our own portfolios, but big picture, where are we? And I know nobody knows, right? That's one of the other big conundrums I think everybody's facing, but we have a pretty good idea.
Well, so in 2021, Richard's right. I told everybody then, I said, if I could put 40 to 50% of everybody's money into energy, I would. Can't do that from a fiduciary perspective. And of course, at the time, nobody would actually want to do that. And so in October, I wrote the article. In October of last year, I wrote an article about FANG stocks being dead. We said, and we were nibbling into stuff like Apple and Microsoft and things like that. We had NVIDIA in our portfolio. And I said then, everybody was expecting, FANG stocks were vastly underperforming the rest of the market. It was like nobody wanted FANG stocks. FANG stocks were dead, were the headlines. Well, of course, those are the best performers this year. So if I could put 100% of our clients' money into TLT and then lock it up for 2 years, and if y'all would just go away and leave me alone, you will be very happy with the return you have in your money, because it's a function of math. It doesn't matter what the Fed does. The Fed does not control long duration interest rates. All they control is anything that is 2 years and in. So if you're buying a bunch of 3 month, 6 month, 1 year, 2 year T-bills, that's awesome. You are subject to the Fed. As soon as the Fed starts cutting rates, those yields are going to plummet dramatically because they're going to respond to the Fed rates. And so when those start to drop, that'll be fine because your bond prices will go up. But then what are you going to do? Because at the same time that's occurring, when the Fed is cutting rates, that's because economic growth is crashing dramatically at that point. And now the Fed is cutting rates to try to stimulate economic activity. So as the Fed cuts rates, economic growth is slowing. On the long end of the curve, that is only controlled by economic growth and inflation. That's it. This chart I'm showing you right here is the 10-year treasury rate versus economic growth. And you can see there's a very high correlation between economic growth and inflation and interest rates. Now, we can also pull that in and include inflation as well. But the point here is that so people are going, well, interest rates are just going up. They're just going to keep going up. No, they won't. Because how do bonds work, right? So let's go back to how bonds work. The government issues treasury debt, as an example, to pay for spending they can't afford, right? So interest service on our national debt will now be $1 trillion just post this recent issuance of debt. We're at 32 trillion and climbing. We're going to be taking out $1 trillion in interest payments plus Social Security, welfare, and Medicaid at a time where our federal receipts are coming in. So in other words, we are now spending more than 100 cents of every dollar just on interest service, Social Security, welfare, and prescription drug benefits. Everything else has to be issued through debt. So debt increases are going to continue nonstop. Can't help it. It's just what's going to happen. The more debt you have, the lower the rate of economic growth you have. While we had a pop in economic activity following the 2020 shutdown because we injected $5 trillion in cash into consumer spenders' pockets, not surprising, you had a big jump in GDP. GDP will return back to its ability of where the economy is actually able to grow, which is going to be 2% or less because of the debt. As a function of economic growth at 2% or less, inflation will be 2% or less. And of course, inflation is already at 3, down from 9, that's falling. And so if inflation and economic growth are returning to 2%, and let's just keep math simple for the moment, let's say the 10-year treasury is 4%, you do the math at home for me. 4% interest rates, 2% inflation and economic growth. What is going to be the yield on treasury bonds at 4% at a time when inflation and interest rates are 2%? They cannot remain detached. They are a function of each other because the bond market participants, when they're buying bonds, they are calculating the inflation risk and the economic growth risk of those invested dollars in the market. So yields have to follow economic growth and inflation. So pick your number wherever you think inflation and economic growth is going to be. And if you're expecting a recession, that's where yields are going to be. So if you go from 4% to 2% on the 10-year treasury, that's a 50% increase in the price of your bond. That's math.
This is a longer term perspective, Lance, that I don't think a lot of people can grasp because bonds are sort of nebulous anyway. And there's also, look at the trends across the world for demographics. Look at that article. We talked about that article from the Wall Street Journal about Europe, right? All this malaise overall, and these poor demographics pretend to lower economic growth and lower rates. I mean, I don't know. The only thing that scares me is Janet Yellen came out and said that we're entering a disinflationary environment. And she's like wrong like 80% of the time compared to my magic 8-ball. So, but I don't think people, everybody's worried about one thing. And we're looking at this, like you're showing now, this huge picture that also does include incredibly poor demographics that filters into that long end of the curve. And no one really looks at that. They just look at GDP versus this on a year by year snapshot. And you're looking at it on this longer term macro trend based on what you're showing now. And that's tough, I think, for a lot of investors to stick with because, we've lost that ability to look at things strategically long term, which is for us, maybe even like 2 to 5 years.
Yeah.
And that's
but Richard, aren't we supposed to be long-term investors? Right. This is always the thing that makes me chuckle with people I talk with is like, oh, I'm a long-term investor, but yet I'm concerned about what's happening, in the last 6 months. Right. My whole portfolio decision process is driven on what happened last month versus looking forward over the next 3 to 5 years and where I expect money and economic cycles and growth to be. So, it's always, a function of fundamentals versus economics. And yet everybody's so tied to what the media is talking about. It's like, oh, the market's up or down today. Why isn't my portfolio up or down today? Who cares? Go back and look over long periods of time because that's what you're trying to achieve in your portfolio over time. And yeah, you can speculate in the markets and try to make some fast money. That's fine. And if you want to do that, great. We can certainly do that for you. But also expect a lot of volatility and potential for a lot of loss along the way. You can't have it both ways. You've either got to, invest on a fundamental basis and look forward over a longer period of time, or you can trade the market on a daily basis. But each of those have consequences. You can't have both.
So what about the narrative of inflating our way out of debt, right? We have a huge amount of debt. We continue. Yeah. Well, that would require austerity, correct?
Well, if you want to try to inflate your way out of debt, you've got to create inflation. How do you create inflation? You've either got to you can do it two ways. Okay, so inflation is the function of supply and demand, right? I mean, that's simply it. We know this now real time by looking at what happened economically in 2020. If I give people a bunch of money and then shut down supply, the people that own that supply are going to sell it at a lot higher price, right? That creates inflation. So how are you going to inflate your way out of debt unless you have either extremely high levels of economic growth to support higher rates of inflation, or you simply just shut down the economy permanently and keep sending people money to create artificial inflation to try to inflate your way out of debt? You can't do it magically, right? You have to make a conscious choice to make inflation. It's simply a function of supply and demand.
You do have to have too many dollars chasing too few goods. And that's exactly what ignited it. And Larry Summers was the one who said on that second stimulus package, this is a mistake because you are going to inflate it. So to your point, Lance, either we're going to be sending checks for $1 million to every household, or we're not, or we're going to be creating the system of, like you said, it comes down to supply and demand. So there's really no way to inflate yourself out of this unless you have really poor policies. And some of our policies aren't that great, but that's a good explanation.
Look, it's just a function. All of this is, and these are all great questions, right? And certainly nobody should take offense to anything I'm saying. I'm cranky. It's early in the morning. I had to get up super early to write the newsletter so I could do this with you this morning. I've not had nearly enough coffee. So, but the point is look, you have to come back and align your expectations with your investment goals. And again, the problem that and this is the reason, look, we've been in technically a secular bull market since 1980. We've had three major bull markets, 1980 to 2000, 2003 to 2007, 2009 to present. We've had major bull markets, and 80% of Americans can't come up with two nickels to rub together to make ends meet. $500 average savings balance, 1 year savings in their 401k plans. This is why you have so much angst. If you go into social media, it's everybody saying capitalism sucks, it's not fair. The top 10% of the economy owns all the wealth. There's reasons for that, and a lot of that we've inflicted upon ourselves. But if investing worked by chasing markets up and down, then everybody would be rich. The reason they're not is because they misalign expectations with what they're trying to achieve. And I have this expectation that I'm going to track the market on the way up, but never have any of the downside. That's just not realistic. You have to manage your expectations to what the economy and the markets can deliver. And nobody can predict what this market's going to do in 3 days, much less 3 years from now. We can only make an educated guess based on history and fundamentals and markets. That's it. That's all we've got to work with. And we just have to look at historical cycles and say, because of all of this, this is going to be the eventual outcome. But things that can change that are things like QE, stimulus, those type of things can create these anomalies in a market. That's fine short term, but long term, the economics and fundamentals are going to matter, and they're going to matter a lot. It's just a function when we get there.
So Lance, David Malpass was on TV the other day, and he was saying something that I've been saying to clients for a while. We say on the radio that I do think that investors are conditioned to believe now that either the Fed or fiscal policy is going to bail them out, and stocks will always come back because of this humongous bailout system behind it. And David Malpass said that, I think, investors are getting conditioned to believe that even though markets fall, someone's coming in on a white horse. That's a really strange, it's a weird way to invest. So I want you to address that. And then second, talk a little about our strategy as far as risk management. We never get all out or all in. We work within those channels and trim and do that, but maybe you want to share a little bit about that.
Sure. Well, so first of all, we have conditioned the markets to expect a bailout. Look what happened with regional banks. I think this is the funniest thing ever. And if you don't get this, you're missing the bigger picture of all this. But, in March, we had Silicon Valley Bank fail. Oh my gosh, we had a bank failure. Then we had regional bank failure. And then Credit Suisse failed. And we had to create this BTFP program from the Fed, which is the Bank Term Funding Program, to provide loans to banks at full face value of their collateral, which was depressed in value because of the Fed hiking rates. That's look, these banks were not bad banks. They weren't doing something nefarious. These banks weren't doing anything like subprime mortgages or anything like that. But when the Fed hiked rates, it suppressed their collateral. And since we are a fractional reserve banking system, that's what created these problems. Now, so we immediately showed up, the Fed shows up, bails out the banks again. And then a month later, we have the Federal Reserve bank stress test. Magically, every bank passed the stress test, including Credit Suisse, which was acquired by UBS because they failed. So again, yes, investors have absolutely been conditioned that every time a problem shows up, the Fed's going to bail them out. The Fed's going to lie to you about how strong the financial system is, and everybody's going to be happy. And that's what's been working for the last decade and a half. That's not going to change anytime soon. And markets are going to continue to respond to every time the Federal Reserve steps in to do something until the time that it doesn't. There is an efficacy to bailouts. And we have been, if you go back and I've tracked the history of this over time, and I've correlated to the size of the bailout or QE program, whatever it was, related to the size of the market advance. Every time that we have had to do a bailout, the size of the market advance is getting smaller, and it's requiring a bigger input of monetary and fiscal policy to create a relative on a dollar for dollar basis. It's requiring more bailout, more stimulus to create the same dollar of market growth. There will be a point where you will do a bailout and it simply won't work. And that's where you have the Japan effect at that point. But this goes back, but to your other question about risk management, look, our job is to try to navigate markets. We're not going to time it perfectly. We don't have a crystal ball. Nobody can predict the future. All we can do is use our economic and fundamental and technical analysis to the best of our ability to try to navigate risk. And our focus is not losing money as much as the market. So if the markets are down 20, our goal is not to be down 20%. That's not our goal. Our goal is to make money on the upside, but our goal is not to beat the market either. Our goal is to try to create returns when we can, but protect that downside risk. And then by doing that, if I can limit that downside draw, that means I'm back into positive territory, compounding money over the longer term time frame. So your investment time horizon has to be 5, 10, 15 years from now. Looking forward, if I can avoid those short-term drawdowns to some degree, not entirely, we're going to be able to create your benchmark rate of return over time simply by a function of not having to make up losses to get back to gains.
Yeah, it's a really good point, especially once you get into distribution phases, that becomes all that much more important. So, hey, I know you guys have a ton of questions you sent in prior to this. You're also asking a bunch right now, which we do certainly appreciate. Some of them are very specific, so we will try to address those maybe offline, just because in essence of time, we would be here for hours. A lot of really good stuff. But I do think, Lance, you're doing a really good job of covering most of this as we go. One question we got quite a bit of response on was, like, what about the BRICS new payment currencies that they're creating? What's your thoughts on that? I know we've shared that on air a little bit before, and you've written about it. But tell everybody, what are your thoughts there?
It's a nothing burger. Look, 70% of all payments in the world are done in the dollar. That's not going to change anytime soon. When the dollar is stronger, and again, the dollar has been declining this year, but that's only because we had such a strong, the dollar is just like the market. It gets overbought and oversold. And when you have an extremely strong rally in the dollar, it gets out of tolerance. And what happens, of course, is as our dollar gets stronger, that weighs on other countries, right? Because their ability to purchase our goods becomes much more expensive to them. So in order for us to maintain a trade balance with other countries, we manipulate our currency. Yes, we manipulate our currency just like everybody else does in order to keep dollars and currencies relatively in balance. And that allows trade to occur and keeps economic growth stable. But again, when the dollar gets really out of tolerance, that does weigh on these other countries. So these other countries go, well, I need to find some other, ways to maybe transact some business outside of the dollar because the dollar is too strong for me right now. And that's why we do about 70% of the world trade on the dollar. The other 30% is being done in other manners. And so the problem, though, and Russia was a great example of this week, is who cares? If Brazil is going to have a gold-backed currency, that's awesome. They're going to create so much for inflation for themselves that it's going to last about 37 minutes and they're going to quit doing this. There's simply not enough gold out there to back a currency unless you're doing just, yes, I'm a gold-backed currency, but it's 1/100th of a penny of gold for every dollar, Brazilian real, something like that, some very small fractional backing. There's simply just not enough gold in the world to maintain a currency. And so if you're going to have a gold-backed currency, that means you can only have a limited supply of dollars. And so the reason that the U.S. can never go back to a gold-backed currency is because the cost of the value of the dollar would be, magnitudes higher, of value relative to every other country in the world. And it would just destroy the economic environment. We wouldn't be able to sell goods to anybody at that point because nobody could afford our goods, but because of the dollar. But Russia was a great example of this, right? So just this week, Russia started seizing currencies of other countries and seizing products. And this is why, Russia, China, Brazil, Venezuela, most South American countries, emerging markets, nobody wants to do business with them because at any day the government can just say, yeah, just take your stuff, right? There's no recourse. There's no rule of law. While we're certainly doing a great job of completely destroying our rule of law in the U.S., we still have some of it left. It's not a lot, but we still have some. And this is why countries will continue to do business in the U.S. dollar, regardless of all these other ideas, simply because where else are you going to go? Who else are you going to trust with your money? And this is why, as a reserve currency, the U.S. dollar isn't going anywhere anytime soon, because there's simply no other choice until we completely screw that up with all these socialist policies that we're trying to implement now in our country.
All right, so we've got a little bit of time left. We've got a lot of questions to get to. Want to just kind of do some rapid fire real quick.
Okay, I'll give you one word answers. Go.
Good. What's it going to take for the spread to widen between corporates and treasuries?
You're going to need economic recession and defaults.
Rich, talk a little bit about sequence of return risk, the math of loss.
Well, sequence of return risk means that over time, you're going to get lower returns. Like cycle of returns move in waves, right? So if you are in a period of poor sequence of returns, that means that you're going to get lower returns going forward. And that poor sequence of returns portends to watching your withdrawal rates in portfolios. So we have built that into our financial plans, where we are expecting forward returns on equities to look less than they are. And we do this because of math, as Lance points out. And we want to make sure clients are not surprised by downturns in the market, or at the least, poor equity returns. So we build that into the program. When valuations get to better levels, and I know this talks about valuations, but valuations are very poor short-term indicators. We're looking at building plans over cycles. So from year to year, we could look sort of dumb, but we're hoping that, well, we're not hoping we're wrong, actually, and you get better returns than we think, because we'd rather have a conversation with you to say, hey, you got more money to spend versus, something's got to change, or the 4% withdrawal rate is really 2%. And there you go. How am I going to live on that? So we are active in looking at markets and cycles, pricing in sequence of return risks over time, making sure that you're looking at things in a pragmatic, realistic way when it comes to retirement and accumulation of assets over time.
So Lance, you just brushed on currency a little bit. What do you think about the CBDC and Fed now? I mean, we're kind of halfway already there with everybody doing digital payments for the most part anyways, right?
It's another nothing. It's I don't want to say it's a nothing burger. It's going to be a way for, obviously from a privacy issue, the government will be able to track every transaction. That's certainly a concern on a privacy basis. We've seen banks, step in to try to, debank people that were, selling guns or whatever it was. So that's certainly, and I'm not discounting that concern at all. But as far as the CBDC goes, we've talked about this for years, that eventually the federal government is going to have a digital currency. They will eventually disallow in some form, either through regulatory measures, et cetera, Bitcoin, Ether, all that is going to go away because of simply, in order to maintain economic stability, you have to be able to control your currency. This is why you can't go down in your basement and print dollars. It's called counterfeiting. And the reason that people don't want you to counterfeit is because you can't control your currency, control in the creation of it. That's where you start to have, inflationary problems and other issues within the economy. So being able to track and maintain currency is going to be very important. CBDC is coming. There's no doubt about it. We're already 9/10 of the way there anyway, because you do everything on credit card, digital payments, et cetera now. So this is just the final step. But what will be interesting is to see what ultimately happens to other cryptocurrencies when these governments install their own digital system. It'll basically be, you have to use ours and nothing else. And that's going to be probably the ultimate end game of this.
I think you kind of addressed this question already, but a quick answer here. What is your view on headline and core U.S. inflation over the next decade? While tight monetary policy can ease inflationary pressures short term, can it address inflation caused by fiscal deficits longer term?
Inflation isn't driven by fiscal deficits. Fiscal deficits are deflationary, not inflationary.
So, Rich, a little bit, and Lance, you can chime in on this as well. Has the Fed had to change their policy? Obviously, they want to take a recession out of the business cycles. That's been clear. At some point, we know that it's not going to be feasible. But has the adoption of 401ks or defined contribution plans changed the way they have to look at things, because people are so underfunded? The companies have passed the burden to saving for retirement on to all of us, right? Versus that. So do they have to be more cognizant of that? Do you think that's something they're looking at? I mean, I would say no, just looking at the numbers, because most people aren't invested.
I would say no. I don't think they really care about that. The government finds ways for you to leak into your 401k and all your accounts. I got an emergency. I got to buy a house. I mean, and Danny brought this up like a conspiracy theory yesterday, but it really makes sense. Yeah, of course they want leakage. You're going to pay taxes on that money. Why not? So, yeah, I don't really think they're concerned about that, but there is something to that auto investment into index funds that might be part of this market momentum that nobody looks, and that money goes in automatically. But maybe you want to address that question about the Fed, Lance. Maybe you have a different view.
No, the Fed doesn't care about 401k plans. What they care about is the broader market in general, because of the translation of higher market prices to consumer confidence. And as we've seen here recently, we've had a very nice uptick in consumer sentiment because their 401k plans are going up, right? So that's the wealth effect that Ben Bernanke talked about in 2010. But the passive indexing issue is a real problem. When you have 30 cents of every dollar going in the top 10 stocks, that's why you have this bifurcation in the markets. And that's not 401k plans. 401k plans are a very small fraction. Out of 190 million workers, 50% of them don't have access to a 401k plan. Of the other 50% that do have access to a 401k plan, only 50% actually contribute. And most of those barely contribute the minimum just to get the match. So that isn't a huge driver of markets. What is a huge driver of markets is institutional money. And that is basically what's been driving a lot of this advance this year. And of course, retail investors piling into ETFs, et cetera. That's all kind of contributing to this very bifurcated market. And that's one thing that's been going on. But yeah, 401k plans don't have a lot of issue with that. But what is the Fed's concern are pensions, municipal pensions, major markets, institutions, hedge funds. That's where all the money is.
So we touched on rates quite a bit. What are your thoughts? Do you think you can see this go higher a little bit before we start to see this thing drop?
On interest rates?
Yeah.
Yeah, I mean, we're going to trade between 3.5% and 4%, as we have been, for a while now, and we're you can't really get much above 4% on the 10-year Treasury before you start really getting into economic problems. That's why every time we get up to about 4%, we start seeing bank crises, or we see housing downturns, or something happens, right? And so It's just that there's so much debt in the economy, you can't get above 4% to any degree. I mean, you could get to 4.1, 4.2, right? But you're not going to 5 or 6. It's just the economy can't sustain it. But eventually, you're going to get, inflation is going to return to 2%. Economic growth is going to return to sub 2%, and interest rates are going to drop to 2% because that's the correlation.
Well, hey guys, thank you so much for your time. We're just over an hour. A lot of questions here. If you feel like you'd like a little bit more definitive answer, don't hesitate to reach out. We are going to have a brief survey after this, so please don't hesitate. If you'd like somebody from RIA Advisors to reach out, have a discussion on what we do, how we may be able to work together or help you guys. Also, if you have topics you want us to address, we do these frequently. Always love to get information from you guys. What's important to you, we'll make sure we try to address those as well. But I know there's a lot of things you could be doing with your Saturday morning. We certainly appreciate you here. We did get a lot of questions on where can you find these charts that Lance has. So go to realinvestmentadvice.com. Check out the newsletter. We do a daily market update. We have a lot of information. You can go to our YouTube channel, The Real Investment Show. Go subscribe there. So we do talks just like this daily. And so a lot of information. You could drink from a fire hose, and we certainly appreciate the information we get from you. And we're going to continue to try to provide you with up-to-date and as good and as accurate information as we can.
Yeah.
So
every chart I produce is either in a blog post or in the newsletter. So if you just go to Insights under realinvestmentadvice.com, the first link is the blog, the second link is the newsletter. Oh, and the third link is our daily market commentary, which we put out every morning at 7:30. All of our charts, everything we produce is in one of those 3 items.
Well, hey guys, thank you so much. Have a great weekend. We'll see you soon.